Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our September monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump in here. First, we hope to see many of you next month at our quarterly investment forum. You should have already received an invitation. We expect over 100 to be in attendance, where we'll go over all of these items in more detail. So we hope to see many of you there. We also, in the hopes that this will root on the Astros for the rest of the year, remind you that our conference rooms are now in the name of famous Astros, Altuve, Biggio, Bagwell, and Nolan. So hopefully this will help with the last 8, 9 games of the year. Also, you'll see new in our office a display of our core values. It was a result of a team project that guide the way we serve our clients, team members in the community. You'll see a reflection of that not only physically in our office, but also on our updated website. Also, some in-house announcements. We announced a couple of things for Henry earlier this year. April received the CFP, promoted in July, and as of September, celebrating 5 years with us serving our amazing clients. So elephant in the room with most recent data we got from the Federal Reserve yesterday. What action did they take on rates? I'm sure many of you already know this, but just to back up kind of how we got here, we went through after inflation spiked a series of rate increases in 22 and 23, 11 in total. Then in 2024 started in September with a 50 basis point cut, and then November and December 25. And since this period of time until yesterday, we had been in pause mode, and the Fed yesterday lowered rates to by 25 basis points and teased at some possible additional rate cuts the remainder of this year. Now, just to revisit what the Fed's dual mandate is, has to do with price stability and full employment. So we're going to talk about both of those things now. The first is the most recent jobs number, 22,000 jobs added in August, 75,000 were expected. So this was a much weaker number than was anticipated. And in fact, we got some significant revisions on September 9th from March of 24 through March of 25. The BLS reported that they overstated jobs by over 900,000, 911,000 to be precise. So that was a significant overstatement, and it raises the question, if that data had been reported at 70 a month instead of 147,000 a month, what would the Fed have done? Would the Fed have acted sooner? And what impact would that have on the stock and bond market? So that is an unanswerable question because we don't know, but that's a huge revision to the downside from April 24 through March of 2025. As it relates to inflation, consumer price, the main CPI is the main index, up to 9, which again is still above target, but still in the 2 range. So basically what was expected is what happened on the CPI level. On the wholesale level, which is PPI, monthly prices actually declined in August by 0.1. So that was a surprise, lower inflation on the wholesale level. And as it relates to where financial markets are currently, we sit near all-time highs after a significant decline in early April. And that decline was measured here, and we almost got to a bear market, which is a 20% decline from a prior high. We were down as low as 19% from peak to trough. So this year's not been without, albeit we're at all-time highs, but we've had a lot of volatility this year. And as it relates to concentration on the top of the market, that remains true. The top 10 stocks in the S&P 500 are 40% of the market cap. The connection in this slide is that they're responsible for about a third of earnings. So what this shows is somewhat of a validation of market cap by way of earnings. You wouldn't want to see this spread wider than it is today. And as it relates to Mag 7, the 23, 24, and 25 still up year to date, but not as dominant of the seven companies versus the 493. Um, so again, you're seeing some change of that, and that's because not all the Mag 7 are up. Tesla and Apple, as of the end of August, are down. As it relates to the economy, the most recent read on GDP for the second quarter was up over 3 after a negative 0.5 in Q1. So that looks like, at least for now, with the recession being defined as two negative quarters back to back, that recession isn't in the immediate cards. We talked a lot about kind of the concentration at the top of the market. This is an interesting slide that goes back almost 40 years, and it just shows the percentage of global market cap that's attributed to the US versus the rest of the world. And this just shows, what was a 30% market cap back 40 years ago is now two-thirds of the market. And you'll see other broad economies either maintaining or declining as it relates to global market cap. So the US is just in a dominant position in terms of share of global market cap. And in fact, to just kind of emphasize that point further, with Google or Alphabet now being a $3 trillion company, if you take the seven biggest stocks in the S&P 500, you get to a market cap of about 20 trillion, or a third of the S&P 500, which is more than the combined GDPs of Spain, Australia, Mexico, Russia, Canada, Brazil, Italy, France, and the UK. So just mind-blowing numbers. And this probably won't surprise you given the data that we've just looked at, but what this shows is the last 15 years, the US versus the rest of the world is about 2 to 1 as it relates to financial markets. And again, the US has just grown as a percentage of global market cap and has outperformed the other major markets. So some reasons to be optimistic on the earnings side: 80% of S&P 500 companies beat their earnings in the most recent quarter. However, the price is elevated as it relates to multiples. So S&P is approaching 23, which puts it in the top quintile of historical PE going back to 1990. And when that happens, when you're in the top quartile, that's this blue chart, the next 12 months return is not as good as if you were bottom four quintiles. And the volatility tends to pick up. So some optimistic reasons are beating earnings expectations. Some reasons to be cautious are markets are kind of fully priced, and they're now at the top quintile of prices going back to the 90s. So how are consumers feeling? Sentiment dropped in August to 55.4 from 58.2. However, when you look at what consumers are actually doing, the most recent retail sales had headline sales rising 0.6 versus expected 0.2, so a 3x above what was expected. So if consumers are worried, they're not showing it as it relates to sales. We will be rebalancing soon and sending out trade notes, so you'll send more about that to put into practice how all of the things that we're talking about today are impacting financial markets. So none of this is a replacement to contact us. If you have any questions at all, please do not hesitate to call. We're here to serve you. And again, we hope to see many of you at our quarterly investment forum next month. If you haven't signed up, please do so and feel free to bring a friend. So with that in mind, we'll close thanking you for the trust and confidence that you place in us. Hope you are all well. We look forward to seeing many of you either in our office or at our quarterly investment forum in October. Until we see you again, be well and take care.